And welcome to CommBank View Economics and Markets, where we unpack key issues each week with expert voices from among CommBank's economists and strategists. Hello, everybody. I'm Mandy Drury, and I'm delighted to be your podcast host. So last week, we delved into what the federal budget in May meant for residential property. This week, we look at the implications of the recent budget tax changes for investing in the property sector, with a particular focus on the commercial property sector. So for that, I'm joined by Kevin Stanley, Director, Commercial Property Global Economic and Markets Research at CommBank. Great to see you there, Kevin. Thank you so much for your time. So firstly, maybe set the scene for us, and what do you think the changes in the budget mean for property investment in general?
Look, over the last year or so, there's been very significant investment into the residential sector. And now that negative gearing has ended, it really does beg the question, where will that capital go and where will those investors go? So it means really a time for investors to stop, reflect, do some research and figure out which part of the investment landscape they want to focus on. And there are a lot of different possibilities, and we think that one of the biggest possibilities is that formerly residential investors will start to look increasingly at commercial property.
And we'll get into the individual areas of commercial property in a moment, Kevin, but let me just back up for a second, because it does seem like the changes in the budget may reduce the amount of available residential rental stock out there in the market, which of course would keep vacancy low and rental growth high, at least until more new builds come into the market. What does that mean for investors?
Well, I think it means for investors that the choices in the residential sector are really now limited to new building. So they really are, they really need to wait and do their research across the sector. New builds take a long time to come into the market, particularly apartment buildings. If you're buying off the plan, new buildings could take a couple of years. So many investors don't want to wait, and I think that's been the attraction of buying existing property, because investors can then just get set up and get their properties on the market, virtually straight away. With build to sell apartments, they take a long time to deliver. You're not quite sure what you're going to get and what the world's going to look like, in 2 years. So they really want to, I think, get moving. They want to, the type of people who like to invest in direct property. They like to, see and touch and feel what they're buying. They want to, manage it themselves. They want to drive past it. So that's one of the long-term attractions of property, the physical element to it. So if you have to wait 2 years, they may decide not to do that. They may decide more to invest into commercial property, and there are plenty of options for smaller scale investments that relate well to the residential sector. I think it throws up a lot of unexpected issues too. Like if investors now are selling their residential properties, they'll be selling them to owner-occupiers, because the investors won't be buying them now. And I guess what that means ultimately is that the pool of rental properties is likely to shrink, existing rental properties for the time being. And we've got some sectors that are building up to provide more rental stock, things like build-to-rent, which is a new asset class for Australia. There's around 15,000 built-to-rent apartments already developed in Australia, and it's growing very quickly. I think these changes will play into the hand of built-to-rent developers. But like the built-to-sell apartments, they do take a long time to build. So there's probably going to be a gap in the market for a while, and you're likely to see the vacancy rates in residential stay quite low, and the upward pressure on rents continue for the foreseeable future.
Kevin, you said something really interesting there, that quite often investors like to be able to touch and feel and drive by their property. So is that something that you notice as a key trend in terms of investors looking for a direct property investment?
Yeah, look, it is well established that investors look close to where they live, and some of the project marketing companies, for example, who are marketing new apartment buildings off the plan, they'll tell you that they draw a 3-kilometre radius around a project, and then they do an old-fashioned, brochure drop in people's letterboxes in that area, and they'll tell you that they can, achieve 70 or 80% of their sales within 3 kilometres of the project. It just seems to be something where people know the area, and they know the features of the area. They like the area. Obviously, they live in the area. So yeah, that is a well established pattern of investors, buying close to home. And look, even the Reserve Bank of Australia recently put out a new paper where they examined the ATO records, looking at where people are investing based on their tax records. And it did indeed show up that most investors invest in the same state. That was the closest, the smallest geography they examined. But what it did reveal is that there's very little interstate investment in the residential sector. There's certainly some, but it's not substantial. Most of it's very, close to home.
So let's now focus a little bit more on the commercial side of things, because it does seem like the Australian commercial property sector is currently experiencing more investor interest, as of course those budget changes to residential negative gearing and capital gains tax prompt a structural shift in capital allocation. So just to give a little background, residential property investors face those new restrictions from the 1st of July next year. But if I'm correctly understanding this, Kevin, commercial assets retain the full negative gearing and therefore you could say could be structurally favoured by investors. Is that a fair thing to say?
Look, yes, it is. And I think commercial property doesn't have really a high profile as an investment class more broadly through the public. But look, negative gearing's always been there for commercial property, and so it still applies. It's probably less needed or less used because the returns on commercial property tend to be higher. So you're not sort of incurring those losses that you need to offset through the negative gearing process. So indeed, that's one of the attractions anyway of commercial property, is that it is higher, has a higher return, and it has more stable returns. It has longer term leases, locked in. So there's a lot of features there that you don't get in residential, but definitely negative gearing does still apply to commercial property.
So what kind of investor does commercial property suit?
Well, I think private investors definitely are still already the major investor category in commercial property, and they can invest up to 40% in any given year. This year, for example, so far in 2026, that number's running at about 33%. So it tends to sort of really be the foundation, really, of commercial property investing year in and year out. So that's very popular with private investors. Other investors in commercial property include, the big end of town, if you like, the A-REITs, the super funds, offshore investors. Love Australian commercial property and are always very active, as they are indeed this year. But there's always that foundation, if you like, of private investors in commercial property, something we think could well be increasing now with these changes.
But to your point about the big end of town, the institutions being involved in the property sector, the commercial property sector, would that make an individual private investor shy away?
Well, not necessarily. I think they're working at different ends of the market. The institutional capital is really targeting much larger scale properties. The bigger shopping centres, the larger warehouses, the big CBD office towers, which is really a different end of the market that private investors would be active in. Private investors were particularly looking at things like industrial property, smaller warehouses, some of which are still available, like under $1 million. They'd be looking at smaller shops, offices. They'll be looking at some of the newer asset classes like childcare centres have become very popular. They have an average sale price of under $5 million, so that's quite accessible to private investors. Service stations. So all these sort of quite a broad range of different categories, but they're all available at a smaller price point. So I think private investors work in that end of the market. Over time, private investors tend to build up their wealth and move upscale, so they'll be moving into larger properties, but they're still not probably in the end of the market where the institutions are, where you're talking, maybe $500 million plus, assets. But over time, private investors do build up their wealth and move up the price points. Yeah.
So give us some historical context then. How has the commercial property sector performed over the past year?
Well, look, it's performed quite well. Sales activity is so far in 2026, for example, trading activity is look, it's 12% down on where it was last year, on the same time last year. We actually think that's not a bad result, given the fact that there have been 3 interest rate increases, these changes coming through from the federal budget, conflict in the Middle East. There's been a lot of change and a lot of big things going on around the world, all within a very short space of time. Most of those are unexpected as well. So I think for the market to still be tracking just 12% below where it was last year is actually not a bad result. And as I mentioned, private investors still account for 1/3 of that. So they're still certainly very, very active in the market. Well, when we think about the things that drive value or price, there's really 2 things that change. One is the rents. As rents increase, they add to value, and rents are continuing to increase across all of the property sectors incrementally, helping build capital value. And the other thing is the yields or the capitalisation rates, which are applied to that income, and they're relatively stable at the moment. Given the higher interest rates, they've been held stable, but there's still income coming through, and that's really being supported by an economy that's still growing, albeit a little bit more slowly, but still a positive economic environment supporting the occupational side and the rental side of commercial property.
But you mentioned those 3 interest rate hikes by the RBA. What does the risk of further RBA tightening mean for the commercial sector?
Well, I think if, investors are, I think at the moment, investors for a lot of reasons would be, just waiting and seeing what's going on, starting to build a bit more confidence. Our view is, in the CBA economics team, is that interest rates have now peaked, and that's certainly been a well-published view, and that during 2027 we expect to see the official cash rate come down again as inflation comes under control. It might take investors a bit more time to feel comfortable with that and to make sure we're tracking toward that. So investors, I think, have had a lot to absorb in the last 6 months. So some will be sort of waiting and seeing that all of these factors do in fact play out as predicted. The Middle East deal has been signed, and let's get that bedded down and make sure that's all happening. And then the last thing is just coming to terms with these federal budget changes and thinking about where the capital that used to go into residential investment property, where that's best to go now. Yeah. So these are big decisions, and these are kind of once in a generation type decisions that need to be made, with all this sort of grouping of factors all coming together early in 2026.
And we should also highlight that commercial property as such is a very broad umbrella. And you've mentioned already some of the different types of commercial property. You've got, for example, retail, you've got industrial and logistics, you've got office, healthcare, childcare, and various others. So why don't we talk a little bit about office demand, given the fundamental shift that we've seen in terms of how we work, particularly spurred on by the COVID era. So what is the impact that we've seen so far of work from home on office demand, Kevin?
Well, look, if we compare the periods pre-COVID and post-COVID, and we look at the office space demand, definitely pre-COVID there was stronger demand and take-up of office space than post-COVID. However, the post-COVID period is actually still positive. It's just not as strong as it was, pre-COVID. And we think the difference is largely, A, work from home, B, that white-collar employment growth has been a little bit lower anyway in the economy, and some of the labour market strength has really been in blue-collar labour markets which don't occupy office buildings. So, look, the vacancy rate in office has increased overall. Different markets are performing quite differently, and this is a kind of question that investors would also need to be asking themselves. Let's have a look at the different performance that's going on in various parts of Australia. Places like Brisbane and Sydney are doing quite well, and the vacancy's coming down. It's a little bit higher in Melbourne. So you've got a lot of different situations that investors could consider at the moment. So really, when we look at the office sector, we actually think that the biggest impact post-COVID has been the building of new office buildings. There's been quite a lot of new office space come into the market, and not all of it is pre-leased before it's completed. And what that tends to do is bring with it some increased vacancy, and tenants move from the secondary buildings to the newer buildings, the flight to quality, as we call it. So that's certainly caused a lift in vacancy, which nationally we think is at about 16% at the moment. And look, a good, healthy vacancy rate is probably half that. So we've got a bit of a job to do to get the vacancy down nationally. But as I mentioned, some markets are already sub 10%, like Brisbane, places like Hobart and Canberra is doing well. Sydney's improving very quickly, the CBD. So, there's a lot of options there underneath those larger vacancy rates that are the headline numbers.
It's curious though, isn't it? I mean, purely from a personal point of view, I walk around the Sydney CBD and I see for lease, for lease, for lease, vacancy all over the place. So, what is the incentive for developers to build new commercial and office space?
Well, I think the institutions are the ones mostly building the new highest quality office buildings. And they have a belief that, tenants will want their space and that will be in demand above the secondary space. So they back themselves around that, and traditionally they would pre-lease those buildings as much as they can before construction commences and during construction. So it's really a flight to quality. They believe corporate Australia, as it grows slowly, even if it grows slowly, will still want to occupy the best buildings, and the incentive is to get the real quality space with green credentials, with your end of trip facilities, with wellness built in. A lot of good views, good light, all the features that you look for in a quality office building is what the institutions offer in the new builds, and they're very confident that the market will come to them as they have. And over time, some of the secondary buildings start to get reused. And this is an interesting feature at the moment. We're seeing quite a lot of older office buildings purchased for redevelopment and removed permanently from office space use. And typically they're going to apartment buildings. As I mentioned, the story's gone full circle, because apartments are still very popular, and the built-to-rent sector, student housing, hotels. There's a lot of uses, particularly in and around CBDs in Australia, that are now picking up these older office sites, which are quite well located, but the buildings are just past their use by date now, and it's time to refresh the area, recycle the buildings, and that process is very much underway at the moment. In the first quarter of this year, there was over 20 buildings removed from the monitoring that's done around Australia each quarter. We're kind of seeing that every quarter now, that could be 20, 25 buildings every quarter being removed from calculations. And most of those buildings will be redeveloped for residential type uses.
Indeed, given the concern around the lack of residential housing stock and the lack of affordable housing, why aren't we seeing this conversion more?
Well, I think there's two elements to it. One is the conversion, as you say, use that word conversion. Not all office buildings lend themselves to conversion because the floor plates sometimes are too deep and you can't get the natural light into the buildings. Some buildings lend themselves to that depending on the design or the size of the floor plate. So it's really more about redevelopment. Why isn't there more of it? I think the cost of it too, the cost of building generally in Australia is very high. And so projects, need to be financially feasible, obviously, to get going, to be facilitated. So that's a very specific equation to each proposal, and if it's not feasible, then it won't happen. The planning rules for residential in Australia are starting to change quite dramatically at the moment, and particularly around building heights. We're seeing building heights lifted, and that will also help financial feasibility because you'll have more floor space to lease, or to sell. So, it is definitely happening, and we'd love to see it happening more. But I think it's a pretty healthy trend, though, to the extent that it's happening, at the moment.
Indeed, I guess it's so much more than just rezoning, isn't it? It requires an entire retrofit of an office building so that each individual space has its plumbing, for example, for kitchens and bathrooms. But backing up to all the various different subsectors of commercial property, Kevin, we mentioned a number of the different types like retail, office, healthcare, childcare, industrial, etc. Which of those subsectors do you think has the strongest outlook from here?
Well, it's a good question. Look, retail is doing very well. The overall vacancy rates in shopping centres around Australia is below 5%. and I mentioned that in the office sector it's at 16%. So we're seeing very strong population growth in Australia. We're seeing strong household formation, and that ultimately leads to the need for more shopping centre or retail floor space. And conversely, the amount of new shopping centres being built in Australia is well below the long-term average. Developers find it hard to find the sites for new shopping centres, or to buy up the land to create sites. You need quite large sites for new shopping centres. They may have trouble getting approval, and then there's the building costs as well. So there's a lot of hurdles, if you like, to building new shopping centres and creating new retail floor space in Australia, and that tends to act as a sort of a natural. It leads to a naturally low vacancy rate in this sector. So you've got high demand through consumer spending, driven by population growth, but you've got low supply, given those hurdles to creating more shopping centre space in Australia. So it tends to be a structurally perfect combination. That means that values will remain high, and gives you the chance to increase income. And so investors are weighing quite heavily into retail at the moment. It's probably the number one traded asset class if we look across the various asset classes, across all the various locations and price points as well.
So, despite the popularity of online shopping, are the dire forecasts of the demise of the shopping centre and foot traffic overdone?
Absolutely overdone, yes. I mean, I remember those headlines well. It was some time ago now when they were at their biggest, but I think they've faded away as shopping centre owners also very adept at changing the mix of shops and services that they offer in their centres and in their retail stores. And we've seen shopping centres evolve more into service hubs as much as selling merchandise, and that's really to pick up on where the demand is. We've seen medical uses go into shopping centres. We've seen banks. We've seen a lot more uses and wellness go into shopping centres, and that's helped boost the popularity of those assets. And I think there's quite a dynamic sector, and if you're prepared to change the mix of tenants and respond to the market, then you can do well, and you'll therefore effectively be competing with online and providing a good offer that people still want to shoppers still want to support.
I'm certainly one of them. And last but certainly not least, Kevin, with the AI boom, there's been a scramble to build data centres. What does the rise of data centres mean in terms of development trends in property?
Well, look, it's a fascinating trend, and it's a global trend, and it's certainly happening in the US as well. We notice very strongly, but Australia's quite prominent in the development of data centres globally. So yeah, it means a lot of construction activity. So it's very good for construction business, at a time when construction activity might be a bit lower in some of the other sectors. It's good that builders have that opportunity to get involved with data centres. It means that communities can enjoy the benefits of that construction activity, and there's a lot of competition around Australia, particularly between Melbourne and Sydney, to locate data centres. And Melbourne has a good land availability, and it pushes itself forward from that point of view. And Sydney's a bit more constrained, but it's also a very big market, valuable market for data centres. I think what it also means is that ultimately, once you build the data centre and you get into operation, it's exactly the type of productivity we're looking for to improve the economy, to improve productivity in the economy and lift the potential for GDP growth. So, I think there's a benefit there both during construction and a much longer term and a permanent benefit once they're operating and supporting a smarter country, a more productive economy.
So if someone's listening to this and thinking, I want to get in on that, how does a direct property investor get in on the data centre boom?
Well, that's a good question. It's not easy if you're a direct private investor. A lot of the groups are large institutions, so if they have facilities available to invest indirectly, that might be a possibility. But you have to remember that these facilities are enormously expensive to build, and they're valued. Some of them will be valued over $1 billion for a single asset, really like as much as a big shopping centre, put it that way. So you need pretty big deep pockets to play in that level. There are some big operators that have been in the market for a long time who are really dominate it now. Some Australian based, some global. So I think probably the best way is if you're a builder, you might get the chance to provide building services or building activity during construction. And otherwise, it'd be probably more an indirect exposure.
Kevin, it's been a really interesting conversation. Thank you so much for filling us in.
Thank you, Matt.
Before we go, let's take a look at the week ahead now with Harry Otley at CommBank. Hi there, Harry. Great to have you with us once again. So the biggest thing in the market at the moment is, of course, and we certainly don't know whether or not it will hold because these things sometimes have a history of unraveling. But for the moment, it looks like peace at last in the Middle East.
Yeah, that's right, Mandy. So we've been, doing this podcast weekly, talking about the conflict for a while now, and it is looking like this is a more clear path towards peace. Now, it is worth noting that the deal that's been signed between the US and Iran is a ceasefire for 60 days that involves the opening of the Strait of Hormuz, which is the really most important thing for global energy markets, and the removal of those blockades. The more in-depth discussions and negotiations around the nuclear program in Iran, for example, has been pushed to negotiations within that 60-day period. So that's certainly not solved yet. As you said, that raises the risk that, this isn't the end of the war completely. But as I said, it is a much more positive situation now. It looks like we have a clearer path towards peace. Now, obviously, the biggest impact that we look to see how markets have responded has been the oil price. It's dropped a lot. It's now below $85 a barrel for the Brent crude futures. So we're operating under the assumption that this is the end of the fighting and the Strait of Hormuz will remain open, and that should see energy markets normalize a lot more from here, which is obviously a big positive.
We certainly hope so, Harry. And we've also got the Fed decision this week.
The Fed decision is the big one this week in terms of the economic events. It's important in a few different ways. Obviously, every Fed decision is incredibly interesting and important, but it is the first one with Kevin Walsh at the helm of the Fed. It's going to bring some changes, we think, over time. We don't think a lot of those changes will be in the meeting this week. The Fed chair, Kevin Walsh, has said that he wants to remove things like the dot plot. He wants to change the way that the Fed communicates. In terms of the meeting itself, we're expecting a pretty easy decision in terms of leaving the Fed funds rate steady at 3.5 to 3.75%. We do think the communication will be a little bit more balanced. Previously, the dot plot, which we don't know if we'll have for the rest of the year, but we think we'll have it tomorrow. We think that will show that the members of the FOMC expect that rates to be on hold for the rest of the year. Previously, they did have a rate cut there penciled in. We think that the next move for the Fed will be up at the end of the year, and we think we'll get another 2 interest rate increases in 2027. Now, that was a bit of an out of consensus view for a period of time, but we've seen inflation edging up in the US. We have that strength in the labor market continuing to come through. And so we think that the next move is up, but certainly a lot of the interest for this week's decision will certainly be on Kevin Walsh and how he plans to change the Fed going forward.
Yes, indeed, because even if the Strait of Hormuz opens, there's always a lag, isn't there, in terms of inflation coming down. And not to be outdone and not to be left out, the Bank of England, the BOE, is also out with a decision this week, Harry.
Yeah, it's certainly going to be a bonanza for central banks this week. The BOE is an interesting one. We think they'll be on hold at 3.75%. What we'll be looking for is how the vote split comes out. We think it'll be a 7-2 decision in favour of keeping rates on hold, but we think there is a risk that might be a few more board members in there looking to increase rates for the Bank of England. They are, to your point, a little bit insulated from the inflation so far. Their electricity prices will reset from July, so they have been a little bit more insulated from the impacts of the Middle East war. So there is inflation in the pipeline in the UK, and we think the Bank of England will be waiting to see that more clearly. There is also the Makerfield by-election this week, which is of interest in the UK. Andy Burnham is expected to win that, and if he is a strong winner of that by-election, the expectation will be that he will try and then go to be Prime Minister of the UK. And some markets have been paying some interesting attention to that, in terms of he is viewed as probably the most likely to be a little bit more loose on the fiscal rules over there. And so there is a risk that bond yields do increase as a result of that. So BOE on hold, but certainly that Makerfield by-election will be of interest as well.
Yeah, some really interesting things happening over there in the UK. Thank you so much for joining us today with the preview, Harry Otley. And thank you for joining us today. Make sure that you follow CommBank View for your weekly analysis on what's moving the markets and economies. My name is Mandy Drury, and it's been my pleasure to have been your host today.